Hey traders, welcome to the 4th of July edition of Charts and Coffee. Yes, I'm in my office here this morning taking a quick look at some charts, updating, cleaning up some layouts, all that good kind of maintenance stuff, which is great to do on a bank holiday. Hope everyone's got some great plans. I can already smell the smokers starting up here before 9 a.m. in the neighborhood. So I hope everyone has some fun in store. But before we get to that, every day, even on a Saturday, I do take a quick glance at the trades that I put on, the setups that could be forming for non-farm payroll tomorrow. We have a full trading session tomorrow on Friday, which means that it really starts with the 8:30 NFP. So just a quick refresher for those of you that may not have checked out the free video that I did the other day, which was Powell puts jobs in the spotlight. And you can check that out, by the way, over at the Simpler Trading YouTube channel. One of the things that happened when Powell was speaking at the European Central Bank panel discussion alongside folks like the ECB president, Christine Lagarde, is that he said that if jobs, employment is starting to slow, right, that would cause them to react. Those were his words. So by putting non-farm payroll, even the jolts, but mostly non-farm into focus, bulls should be, quite frankly, rooting for a little bit of a disappointing number. Now, how disappointing? This is where it gets interesting. Bonds reacted really well to the missing data on the services, the ISM services PMI on Wednesday. So we know that bad data, disappointing data is still bullish to the market, right? To equities, to stocks. So as long as we're in that environment, the message is really simple. If the economy, if employment is showing signs of wear, is showing signs of heaviness because of these rates staying higher for longer, that's going to compel the Federal Reserve to cut potentially as soon as September. November and December are pretty much in the cards. In fact, it would be a huge disappointment to equities if November and December aren't on the table. But September's been kind of waffling. And as of Wednesday, that September probability shot up. We'll talk about it again Friday when I'm with you all for Charts and Coffee, and we'll see what those probabilities look like. But here's the thing we want to be ready for, and that is really simply this: accepting two basic ideas and just accepting them because that's been the way that the indices have been moving. One, the Federal Reserve has been gearing up for a cut, at least up to 3, most likely 1, and very probably 2. The third cut would be absolutely gravy, and it would keep the overall markets, the indices like the NASDAQ heading higher. All right. In the midst of all this, starting in mid-July, we're going to be going into earnings season. And on the 12th, we have the kickoff of earnings season with 3 heavily weighted financial stocks in the XLF. Now, NASDAQ is moving higher because the technology sector, XLK, because semiconductors, SMH, communications, XLC, have really been leading the charge most of the year. We haven't had an issue with Meta, Google. We really haven't had an issue with Microsoft, Apple. I know Apple's been volatile, but we know semiconductors, NVIDIA, Taiwan Semi, those have all been helping the NASDAQ move higher. And the ES coattails the NASDAQ because so much of the S&P's weighting is very much like the NASDAQ. All right, so then that brings up XLF, and this brings in another sector that could keep the S&P moving higher, and a sector that is the most important in the Dow and could help the Dow start to play a little bit of catch up with technology. And that is if XLF starts to rally in front of the earnings, if earnings are solid and keeps that strength going, the Dow could be a little bit of that sleeper right? We want to be looking at some bullish setups in the Dow as we go into earnings season, as long as financials continue to move higher, and definitely after mid-month when we get a couple of those really important financials earnings. All right, so that's where we sit. So I wouldn't take the Dow off the table. In fact, I wouldn't take the Russell off the table either, although I'm not as interested in the Russell as we are the Dow because we don't have the green candles yet. But the indices do look supported. And when it comes to the NASDAQ, they're in an uptrend. Russell and Dow are not in uptrend. So one thing to look at as we're looking at the Russell would be a really nice compression to expansion setup, because at the end of Q2, rolling into Q3, the regional banks just took a leap forward, and that's going to help the Russell a lot. Even names like SMCI will help the Russell as well. So here's the setup. It's very much contingent on a market that's moving in a sideways narrow range. And to understand a sideways narrow range, we have yellow candles and Darvas zones. So if we're taking a look at the yellow candles and the Darvas zones, what we have here is resistance at about 2085 and support at 35.36. Now, what happens in a range is we could be stuck in this range for a while. And the more the candles stay neutral, the more they're at least not bearish, right? But because KRE is showing signs of strength, what I'm going to focus on is the lower half of that range, or as close to say 2040 to 2035 as possible. So there's a nice 5-point range at the very bottom of that zone. What that allows us to do, rather than waiting for the momentum breakout, which I'm frankly not a fan of unless that's the second stage of this setup, that is buy in this area and take half profit or quarter profit or whatever you'd like, but scale out around 2085, and then you're pretty well positioned for the momentum by having already bought lower in the range. So if the momentum breakout never happens, or if the momentum breakout doesn't happen before the option expires, or for whatever reason, you would pull the trade, you've got an opportunity to scale out and move to break even. And these are things that we do. We look at these considerations in the Sector Secrets Mastery. Now, when it comes to the Dow, we don't have that narrow Darvas, and that's fine because we have these daily price movement ranges. We want action like 628 or action like 7.2, so June 28th, July 2nd, green candle meets the gray zone, right? Talk about paint by numbers, and that'd be a great spot to engage Dow and Russell. I mean, I've talked a lot about the NASDAQ and the S&P, and we're starting to see a little bit more clarity. Now, what if non-farm payroll prints say over 200 or 210? I've seen consensus as low as about 160, and I've seen consensus as high as the 190s. Now, that means in order to miss, we not only need to print below 190, but probably lower than that to signal to the Federal Reserve that what we expected is not what we got, and the jobs picture isn't as rosy as they would want. And then that would probably increase probability. That would increase the probability for a September cut. That would send the markets higher. A miss in non-farm payroll is going to maybe create the typical 830 wick and then up and away. Now, if we print over 200, so let's look at it as a miss. A miss is actually going to be bullish, right, to equities, to bonds, but a beat, better than expected, a good jobs number is going to create a pullback, because that will likely take probability out of September rate cuts, and we'll get that dip. I'm kind of rooting for that, because if I want to engage some of these strong stocks and sectors, I need a pullback. I don't want to be buying at higher highs. I don't want to be engaging where I need someone else to be willing to pay more than I did for the equity market or for that ETF, that option to go higher. All right, so that's the scenario for Friday. All right, so if you have any questions, feel free to type them on in. That's the plan. That's the game plan for the rest of this week. And in the meantime, between the bank holiday and the uncertainty about whether or not the Federal Reserve may or may not have September cuts on the table. We've seen a lot of volatility intraday that's been a little tougher than normal to trade. If you're struggling with position size and risk management, come check out what we're doing in the Sector Secrets Mastery. We have a formulaic approach with an adjustability of dealing with volatility versus, trends that rarely tend to pull back past their daily price movement ranges on their way to higher highs and higher lows. We have to adapt to what we're getting. Ultimately, though, for those of you that were in the Friday session, Friday week ago, basically, at the end of the quarter, we were looking at long tech, long Tesla, long just about anything that's been in an uptrend on a pullback with the profit taking that we saw end of quarter. And, as we have talked about, this is not the end of NVIDIA. This is not the end of semiconductors. A lot of folks say, we've seen peak NVIDIA. Hardly. What we saw was profit taking into Q2. A little bit of rotation into XLE as the crude oil market remains pretty darn strong. Okay. So first question up here is, good morning. ACMR. And for a swing, and TTD for a breakout swing. Okay, let's see what we've got here, Topspin. All right, so ACMR has broken the downtrend, and it did that in mid-June. We've been kind of flopping around since, but I would definitely start to look at the long side north of about 22.5. And so then the question becomes, from where? Can't say that I have a really clear level that I love. I know that I want to be long. I don't quite have a setup at the moment, but I would look to the long side on ACMR. And it's okay. Look, gang, not every chart is going to have a setup that is ready to go with some proximity. But it's good to be able to put certain names on a bullish watch list and say, look, if we get a Darvis, if I get a setup, then I will. But right now, I'm not seeing one on ACMR. But that doesn't mean we can't put it on the long list. I would. All right, TTD, gorgeous uptrend, steady green. I won't say gorgeous. Let me take that back. That's a little exaggerated. Solid uptrend, definitely bullish because you see all the green candles. So the question is, Rog, when do we engage something like TTD? Really easy. Every time a green candle sinks either into this Darvis level sitting at about 95.20, or if we touch the three lines that are my mean reversion zone, which is the top tier wave. The green, yellow, red is a zone for mean reversion. I look at mean reversion solely within the context of the uptrend. And even though this one's wobbling a bit, it's certainly still an uptrend. So the mean reversion would be valid, as would that Darvis level you're seeing right there above 95. So I would not look for a breakout. To me, breakouts and swings, they're two different legs. So Topspin, this would go back to what we talked about earlier, which is buy the pullback into the bottom part of the zone and then look for the breakout after. So I don't have a breakout. In fact, I have very few breakout setups because they put you out on the end of the tree limb. So what I'd say is, any pullback like what we saw at the lows on the 28th or the 1st sets us up for at least taking profit around 99.50, 99.60. And then the second leg, after having scaled out, after having moved to break even, becomes that second leg for the breakout. So first leg is buy that dip, buy that support level. The second step is, can we see the momentum? But by then, I do want to have at least maybe scaled out and paid myself a bit and moved to break even. So we're in that second stage, if you will, of what TTD could do. Remember, 100 is overhead, and it's a major psychological level. And major psychological levels likely will have a lot of stop orders in that area, probably starting as soon as 99.80, but extending up to about 100.20. So if we see a little bit of resistance up in there, it's likely the battle that's occurring as the buy stops are meeting the sell stops, as the buyers are meeting the sellers. It's just a battleground that we'll see around 100. But that's why we'd like that to be a spot that we pay ourselves proactively. And then with the remainder of the position, because I'd like to scale out, not just get out. And we can see how much higher is high. All right, next up is thoughts on financial services. Yeah, so Imanu, we definitely like a handful of names in the In the XLF right now, it's pretty much limited for me to JP Morgan, to Citi, to Bank of America. There might be a few more that are emerging with some good clarity. It's not really yet ready for prime time, but there is a catalyst waiting just, basically about a week away, and that's going to be those earnings. So I like the green candles in the gray zone for Bank of America. I like the green candles in the gray zone definitely for JP Morgan. The same thing goes for Citi. I'd probably make Wells Fargo. I'd put that one on the list. So Wells, Bank of America, JP Morgan. Now, what I won't look at are things like Visa. I don't want to be buying candle charts where the daily candles have been red, have been bearish. So it's still very much a stock pickers sector within financials, but it's definitely waking up as we see that the earnings season, right, is right around the corner, and it kicks off with financials. Joe, you can join me every morning, Monday through Friday from 9 to 9:20 for Charts and Coffee. If you're interested in getting my indicators, my trade setup, spending time live during the market hours with me, you can check out sectorsecrets.com. That is where I send out my alerts, where I send out premium videos, my newsletter. All those things are part of that membership. All right, Amazon. Yeah, Amazon's been a good one for us. Now, if you're wondering what happened on Wednesday, and Amazon's still a nice buy. Why? Here's the thing. We bought it on the end of the quarter. So being able to position in this gray zone gives me a lot of latitude to handle some flux up near 200. We've already scaled out of Amazon at 198. We do have some traders with the July 5 expiration, and those trades again have already been scaled out, so they have their break even. But the cool thing about the July 5 is either Friday morning stops those out at break even and it's still a winner because we've already scaled out, or we end up with a non-farm payroll that sends everything higher, and those traders can exit the July 5 190. We buy the 192 and a half calls before preferably noon. Now we have another set of traders because I put some flexibility on the expiration date. We have some traders that are in July 12 and July 19. It's not as pressing a matter. I like the overall strength in Amazon. It just formed an uptrend at the close on Wednesday. So I am looking for higher highs on Amazon, but the next opportunity wouldn't be probably till we go back down and tag 195. All right, SOXL. I typically don't trade any of those 3X and 2X myself, Orlando, but anything that SOXL is doing is going to be really tethered to SMH. So I'd keep an eye on SMH. I'd keep an eye on NVIDIA, Taiwan Semi, those heavily weighted stocks in the SMH. And then if you want to go SOX or SOXL, the leverage, at that point when SMH has a trigger, so too will the leveraged alternatives. So yeah, if we can pull back on SMH, I want to get into SMH, and then whatever variation of semiconductors you want to engage in, absolutely. But keep an eye on the heaviest weighted stocks. I'm going to just jump on over to my other screen here. Bear with me. All right. So what's in an uptrend in semiconductors right now? In nothing, right? But what's bullish in semiconductors? NVIDIA, Taiwan Semi, AVGO, AMAT, LRCX, and I'd even probably most recently throw Texas Instrument into that group as well. So definitely a sector where a lot of stocks are bullish. It's wobbled out of the uptrend. However, green candles tell us what? It's buy, it's long only. So I do like that. And then whatever variation of the semiconductors you like, SOXL, etc. Absolutely. As far as MU, I'd leave alone, Eddie. Yeah, because for example, take a look at NVIDIA. MU is trying, but it's not yet really. Yeah, it's not blowing my socks off. Pun intended. The NVIDIA chart, take a look. Green candles, look at MU. A little bit of a laggard, right? little bit of a laggard. Look at AVGO. A lot of folks have been asking me about AVGO. Look at if you waited for the mean reversion, the beautiful setups that were on 625, 626, 627, even 628. Now, AVGO is a spendy option, so not necessarily friendly to smaller accounts. But if you're looking for what a mean reversion can do, and you're looking for that timing where risk control and a very good buy on the call is possible, 4 sessions before it took off. So why chase if you know something's generally strong? It pulls into that mean reversion zone. All of that's automated on the chart. And then you set yourself up for what was a beautiful move through 1700. So MU is just not doing those things, right? So I'd probably steer clear of MU for now. All right. What is the charting platform that I'm using right now? This is Think or Swim. I also use TradingView. I'm a big fan of both of those. What about MELI? So starting with structure, starting with candle colors, I'd have to leave this one alone for now. Could it be supported? Look, if you're looking for something here, I'd keep an eye on that zone between the Darvis and the white dots. So that's the equator. This is the difference between the bullish hemisphere and the bearish hemisphere. But that said, I try to steer clear of stocks that are printing red candles if I'm going to buy. But I would be most interested in the long side of that, Caleb. Yeah, I would be most interested in the long side of that. Just it's not ideal. I'd rather have the yellow neutral or the green bullish candles. Question on NIO. Same thing. We're coming out of a red environment. We're trying to break the downtrend. We're trying to go neutral. With something like NIO Showtime, I'll tell you what, anything under $10, anything under $20 is a volume game, right? Price really doesn't matter. I'm not going to put a lot of stake into anything other than the color of my candles and volume profile. So I would either anchor a VWAP on this one, maybe to the April 1 or the first trading day of the Q2, or I'd keep an eye on volume levels and a point of control on NIO. Anytime you have a stock that's under $10, under $20, you'll notice that the greatest engagement comes with where those price-based volume levels are. And they, in many ways, act as the support and resistance. Above $20, price can be a little bit more a driver, but under 20, I found volume actually is better than price. All right, gang, as always, thank you so much for being here for Charts and Coffee. I'll be back tomorrow. Tomorrow's non-farm. We'll see what the aftermath of that is. In the meantime, enjoy your day off. Enjoy the bank holiday. I hope everyone has some great plans set up. I'll be working a little bit. I know a lot of folks are working as well, but we'll take a look at what's happening after NFP next week. Be good to each other, or next session. Be good to each other, gang. I'll talk with you soon.